Good afternoon, everyone. Thank you very much for joining us today for this lunchtime webinar on how to invest as an expat. My name's Andrew Talbot. We're live in Singapore and we're on YouTube. If you're watching through this through Zoom, then you can obviously ask the questions, and please feel free to ask questions throughout the webinar. And if you're watching it on a recording, then feel free to write to me, Twitter, Facebook, LinkedIn, email, or through our website, which will be at the end of the presentation. So I'll turn the video off so it's not distracting, and we'll get cracking. So we're going to talk about how to invest as an expat. So all of the different factors that involved, depending on where you are in the world, including why you do it, how and where. So if we the first one is why. Where. So goals and financial planning is the reason why you'd want to do this. So this could be retirement, it could be education fees, it could be just saving for a holiday, saving for a house. What's the point of or why you need to invest, or you feel you need to invest? And then how, which vehicles, platforms, fund structures, everything else that's important when you actually come to invest. We'll go through the different factors involved with that. And then where. So this is the actual funds, this is the risk metrics, this is all of the theory and the practicality of actually how you do invest and what to look out for. So if we start with why, you need a clear goal. You need to understand what's going on. As I said before, it's probably for a retirement, but they need to be attainable and they need to be measurable. I need to retire in 27 years time, or I need to retire in 15 years time. I want $1 million. I need $2 million. Those are the areas that you need to think about. So clearly define what those goals are. And then this is all part of the investment plan that we put together, or you can put together. And you need to understand what the risks are, the restraints that you will have within the investment plan. I want lots of return, but I want no risk. Well, you need to make sure that we understand what those factors and what those constraints will do to the plan. And it can be very complex, or it can be very straightforward. Generally, a basic plan is a good place to start, and we'll come on to one shortly. But generally, if people don't have a plan and they just go in investing, then you can get sucked into, well, this fund's doing really well, this top quartile, or this manager is very good, I'm going to buy into it, and then you end up selling low. So understanding the plan is extremely important, and to take no notice of the fund ratings or whether they're top quartile or anything else that goes with that. Don't get seduced by the marketing. So we'll go on to just the theory around it. So this is an example of a goal or as a financial plan, and you can see that the objective is, I want to save for retirement. I've got 22 years, I've got 33 years, it's your individual to you. And my risk profile is, well, any of the ones that we'll come on to how you do that. And then what are the savings? How much are you going to put away at the start or as a month? What is the initial capital amount? And then where do we go with the investment mix? What type of allocation are we going to achieve? And we'll go on to what that is shortly. And then how often am I going to monitor it? Am I going to monitor it every month, every day, or am I going to monitor it once a year? What are the criteria? What are my rules about buying and selling? So the plan is very important. Right, so different investment platforms. Platforms are effectively like just an empty box, and it's dependent on what you put in them. And all it is just an ability to buy and sell an asset. And there's various different versions of this. Some of them are very tax efficient. Some of them are electronic, some of them are obviously online. You can buy lots of different assets, but it really does come down to, as an expat, what options do you have, and where are they residents? Where are you residents? And how easy is it to open an account? So if you're, say, an American, then really you want to be investing in American platforms. You're going to be paying tax worldwide on them, and you don't be touching else. If you're trying to get into, say, a UK ISA, independent savings account, you're unlikely to be able to do this from Singapore. The same with an Australian. If you wanted to maybe contribute to your super, what are the providers' rules on you making contributions? What are the tax rules around it? So they're all different platforms. They're all part of investing. And so you got to understand, okay, what have you got? What can you get into? What is the cost of the platform? And then what are the costs of the funds? If it's a very expensive platform, you need to say, well, what other options are there out there? And similar to what can you buy? And we'll go on to some of the options that you can purchase, including the currencies, because that's a major factor, especially as an expat. Is one of the real big rules that people tend to forget about. It's, well, I'm just going to invest in US dollars, but if you earn it in Sing dollars, then you're going to have that tax, that currency fluctuations, or where you're going to end up. If you're going to end up back in Australia, then you're going to have some Aussie dollars that you need to spend it in. But if you're earning in US dollars or euros or pounds, then it will have a big factor on whether or not you're going to end up making a return. The tax considerations are hugely important. As I said before, if you're an American, then really you should be having an American product. If you're going to end up in Australia, then you want something that's as tax efficient as possible there, and the same as Europe or UK. What is the tax efficiency? So here's some examples. I mean, these are investment link schemes. So these are some of the companies that get promoted to expats. They tend to be insurance based. They can be quite expensive, but they will take you from different parts of the world, and they are really tax schemes. So if you're into a particular area that you need to mitigate tax or defer it, then you look at these type of schemes in order to achieve what you want to do in respect to that. If you're an American, don't go anywhere near these, because it's not very tax efficient for you, and the cost is prohibitive. It's too expensive for what you want to achieve. These are some investment platforms. Assets you can buy, but maybe that's not what you want. So we'll come on to some of the reasons. I mean, Saxo Interactive Brokers have investments, and some of them are you consider to be derivatives or financial instruments. And for the majority of people who are trying to sell, for you to start using them, they're very, very complex, they're very sophisticated. The majority of people don't really need to use them. They just need to have quite a simple investment strategy. So understand what you can buy, and we talked about the residents, and we talked about the options. And so these are some of the structures that you'll see on platforms. Majority of them are just by mutual funds or unit trusts. We call them pooled investments. So you're in with another investor. We'll come on to some examples of pooled investments shortly. And then obviously you can have direct equities, you can have exchange traded funds or ETFs, CFDs, foreign exchange, direct investments. You're into the higher levels of the risk profile or the risk metrics. So you got to understand what are you trying to buy. Does it fit in with that plan we talked about at the start in terms of the risk profile and the asset allocation? And we've got to see what we can buy and some of the factors involved in it. So here's an example of a unit trust. It's just a mutual fund. It's pooled with other investors, and these are probably the majority of vehicles that investors will purchase equities or invest in. They tend to exist in pension funds, and they can be retail or they can be sophisticated investors. They can be a whole range of different structures, but they're generally professionally managed. They're invested in all over the world. They're liquid. There's no lock-in. They're well diversified, and really you only need a small amount of cash to start with. When they say they're less volatile than going to a direct stock or a direct share. So you're pooling your investment, and the underlying investments could be 100 different shares on the Nasdaq or the entire S&P 500, which is an index. It could be the Singapore Stock Exchange, and they could just be investing in that. There could be a fund manager on there. There might not be. It really depends on the underlying structure. If we talk about an investment that doesn't have a fund manager, then here is exchange traded funds, or ETFs. They tend to be a low cost alternative. And you can see the difference between that and a unit trust, where unit trust, you still pull in investments, but they have some extra liquidity, whereas an ETF really is you trade on a stock exchange. So it's held similar to a share, but it has similar characteristics to a pooled investment. So you can see the individual stock characteristics, and then say an index fund characteristics. So understanding what you're going to buy in terms of whether it's a unit trust, a mutual fund, or an ETF. And generally, these investments will have names that will indicate where they're invested. So if it says a unit trust is a company, North American equities, it's likely that you're going to be buying the New York Stock Exchange or NASDAQ. You're going to be buying American companies. If it says emerging markets fund, then it's likely that you're not going to be buying Western Europe funds, equities, or North American equities. You're going to be buying South America. You're going to be buying certain parts of Asia. Those type of companies are what you can invest in. If you're going to be buying, say, fixed interest, it's likely that you're going to be buying bonds rather than any equities. So normally the title of the stock or the fund will indicate what the investment is. Some more information on my website there about ETFs. So it goes into a bit greater detail on that. So cost of vehicles and cost of funds, very, very important. Minimize the cost. Markets are incredibly unpredictable and you can never know where they're going to go, but costs are predictable. You understand how much is the cost of the vehicle and how much is the cost of the fund. So if a unit trust has a fund manager on it, you'll be paying for that fund manager's expertise. Whether you think they're doing a good job or not, really down to your own philosophy. ETFs are the other example I gave, are very cheap. They don't have a fund manager on there. There may be some other risks associated with it, but they tend to be quite low cost in the way that they're structured. So it's very essential to understand what the cost of your platform is, what the cost of the funds, and that will determine whether or not you're going to make that extra return. It really does matter. I mean, every dollar that is paid to a fund manager means that it's less for you in retirement. So really drill down and do a deep dive into what your current portfolio is. It may be worth paying for a fund manager. Certainly if it's maybe a smaller cap, you might say the fund manager adds some significant value than just buying an index. But that really is down to your own particular philosophy. But trying to minimize that as much as possible, I think is very, very important. And I can show you an example, right, where this is a fund by Vanguard, who are an ETF provider, and you can see the difference between, effectively it's just the same fund, the same underlying investments, just going to buy an index. One has got a 1.2% annual management charge, and one has got 0.3, and you can see the difference. It's almost £12,000 or dollars or whatever you want to put the initial currency in, and that's just over a period. So the costs will have a big impact. So really look about what those costs are. So the key takeaway for me is you can't control markets, but you can control the costs. So lower that as much as possible. So where are you going to invest? There's a couple of important points we'll go on to. First one is asset allocation, asset classes. Diversification, spreading your money across those asset classes, understanding the risk. and then really let's construct a portfolio. And I'll give you some examples of that. So asset allocation, develop a suitable application. The investment strategy would always start with the objective. At the start, we talked about that investment plan. We said, where's our allocation going to be? So if it's going to be aggressive, then the allocation is likely to be into more aggressive assets. I'll come on to some of the assets that are available or that you can put your money into. And it really is about balance. It's not putting all of your assets in one basket, the old wives' tale, but it does hold true today. So the allocation and diversification. And the more diversify, the more you lower that volatility, which is just a measure of risk. But be careful that if you diversify too much or you try and get rid of volatility, basically you're in cash, and then you're into another type of risk, which is the fact that you're not outpacing inflation, or you're too cautious. You're not going to achieve the objective that you set in your initial plan. So it's not just about up and down. There are other risks to take into account. If you've got all of your money with one institution, then you've got an institutional risk. You've got maybe a country risk. If it's a bond, then you'll have a credit risk. Currency, huge for expats. One of the big risks that you need to manage. Where are my investments? What are they held in? Where am I going to end up? What's the vehicle? Will it allow me to invest in different currencies? So other different risks are you need to take it into account. These are the asset classes that generally are available to investors. You can go to sub-asset classes. So I could have one of them is shares or equities. I could have emerging market equities or developed equities. We talked about that earlier. But you can see it's either cash, it's fixed interest securities, which are bonds, whether that's government or loan or corporate bonds. You've got shares, you've got property, and then you've got the alternatives, which are pretty much everything else. And some investments may say they're an alternative, and they may invest in property, they may invest in shares, they may invest in a whole range of different asset classes. Commodities, for instance, could be put into an alternative investment as gold or other structures or other assets. But the risk profile will generally depend on where you're going. So cash is obviously considered a low risk profile, but the money will be eroded by inflation over a longer period, especially if interest rates are very low. Whereas something like fixed interest, although they're predictable because a fixed interest security will pay you an interest or pay you a coupon every year, and at the end of the period you'll get your money back. They can still trade similar to shares. They can still be volatile. There's still a price on there. So depending on where you get in or where you exit, you may be at a discount, you may be at a premium. And even with equities, investing in a single company such as maybe Apple, for instance, can be high risk. You've got all of your investments in one asset, one company. If you invested in an ETF that was North American equities, it probably holds Apple, but it also holds a number of different other companies within that sector. So therefore, you're spreading your risk along those. And the same with property. If you're going to buy, if you have a residential buy-to-let or a number of different property portfolio, then your risk generally isn't the prices are going to jump up and down. It's whether or not you can sell it. What is the tenant going to pay the rent? Maybe there's some tax, the risk you need to think about. So it really depends on the asset class. And diversification is obviously the key to it. That's how you manage risk. Very powerful strategy. Spread your assets across all of those different asset classes we just saw in that table. And it really is just common sense. It's the old wives' tale, as mentioned before. Each market will behave differently to one another, so have a concentration in one market if your risk profile allows it to that, or spread your concentration across different asset classes. So the key takeaway for this is asset allocation and diversification are very powerful tools. Managing that risk, managing where your assets are held. So if we go on to the human element, this is really about you. How much loss can you take? And risk attitude or risk profiling, and we'll come on to how you do that shortly, is really subjective. You're influenced by what's happening around you. The moment markets are rising, so people feel comfortable in putting money into it. If the markets suddenly change because there's maybe a geopolitical move or markets start to go the other way, then people feel less comfortable with it and they tend to take the money out. So understanding what your behavior will be towards that is important at the start of your investment plan. If you feel that I can take a 10% loss or I can take a 20% loss, then you need to think about how that works. And also it depends on how long you're going to invest. So if you've got short-term goals the next couple of years, you keep your money in cash. Medium-term or long-term goals, you'll have probably a higher allocation to more riskier assets, more equity exposure, less bond exposure. The longer the term, the more equity you have, the higher risk. You can ride out those falls and take advantage of the ups. So your risk profile, this is a company called Finametrica, and they'll do your risk profile for you. Probably cost you, I think it's about $50 or so, and they'll give you tell you what your risk profile is. As a financial planner, we use them all the time, especially when we're going to look to do some investing as part of a financial plan. This is the key element to it. We need to understand what your capacity for losses or what your tolerance is to it. And generally, at the end of it, you end up with being labelled in a little box. And here's examples of 5 different boxes, from conservative to moderate to balanced to growth to aggressive. And really, what does that mean? It's really just what the composition of those different assets we talked about and the percentage allocated to them. So if on a broad stroke, if you looked at the green slice in that pie chart for conservative, it's half the portfolio. Now that is probably fixed interest. And as you go through the different risk levels, you can see that green slice decreases, and it's because you're having less allocation to fixed interest and you're having more allocation to equities, which is probably the blue slice. And really, what this is the theory behind it. So the bottom of this chart is risk, and the side is return, and that's the relationship between those two. The more risk you take, the more return you're likely to have. It can go the other way, but it's I think generally everyone understands the relationship between risk and reward, but it really is part of planning your portfolio and understanding where that sits. So here's 4 examples of a portfolio. Now this is from BlackRock, and it's in Aussie dollars. That's why you've got Australian cash, but it's a nice little graph, so that's what I've used it for. And you can see where the conservative, we've got quite a high lot to composite bonds, which are effectively fixed interest. So if you're an Aussie dollar and you're conservative investment, you're probably going to have 17% in cash. As you're a bit more aggressive, maybe you're quite young, you've got a longer term to think before you need to spend this cash, you can see that the aggressive holdings are likely to be the world equity. And it says there, core, MSCI, which is Morgan Stanley Capital Index, all cap world equity. And your cash level, Australian cash, is quite low. So here is a great example of how the composition of that portfolio is changing because of the risk profile, and then what you actually buy. And these are examples. So there's another example here. This is Stashaway, which is a robo-advisor just about to launch in Singapore. And you can see that they've got some growth ETFs in there. They're just low cost, but you can see where their mixture is. So they're going to say, we're going to buy the S&P 500. It's got to be a reasonable allocation to that. We're going to buy some small cap growth funds. So that's going to be fairly aggressive. But on the protective side, they've got a lot of fixed interest. They've got a lot of bond funds, and that's the spread between the two. I think this is quite a balance to aggressive portfolio, looking at the pie chart in the middle. Right, so to-do list. Each goal has a specific account, must have a specific purpose. Is it a retirement account? Is it for the short term? That plan at the start is very important. Consider the timescale and the risk for each of those accounts. The longer the term, the more risk you can take. The shorter the term, the less risk you take. Think of the currency and the tax. It's a big impact for expats, the currency and the tax. Where are you going to end up? What are the tax considerations? What are the currency options? What vehicle can I open? What vehicle can I hold? Will it make a difference to that tax? Will it allow me to buy certain currencies? And then build or construct your portfolio using all of the different metrics we talked about, the risk profiling, diversifying across assets, picking your right investment fund, and then monitoring it. This is important. Now, if you're a bit more active in your investment, then you probably want to monitor it a bit more. And you're saying, I'm taking a tactical decision on buying oil, for instance. You probably want to say, well, I'm not going to leave it for a while. If you're going to say down the passive route, I'm just going to buy my portfolio. I'm just going to leave it for a while, leave it for a number of years because I know it's going to outperform. Then maybe don't need some monitoring, maybe some risk rebalancing. So it's important to understand what happens with them. That's me. If you need any details, then this is these are the ways to contact me. You can do it through Facebook, LinkedIn, send me an email, get via the website expatfinancialplanning.com, and really we can talk about your own individual circumstances. It is pretty straightforward. You just got to find your vehicle, find your allocation. You can do it yourself if you want. Just make sure you get your plan at the start. That's the key to it. And set your criteria, set your rules, and then run it that way. So thank you very much for stopping in today. Hope you enjoyed your lunch. And please feel free to watch it again on YouTube.